All right, all right. Welcome everybody to the Turtle live stream. We are going to begin any minute now, and we have a fully packed day where we are going to dive into credit, private credit, tokenization, and learn a lot about Alessio as the founder. So we would just give it another couple of maybe another minute here, and then afterwards we're going to dive straight into today's session. I see a lot of people are tuning in on X on the live stream, so that's good. All right, actually, let's just kick it off here. So at Turtle, we have been doing these live streams once every 2 weeks, where we are diving into different platforms and protocols, and we are speaking directly to LPs and investors and educating them around different teams that we at Turtle are working with. Today, we have Creddy and the founder, Alessio, and we are going to dive deep into Creddy, private credit, what they are and what they do. So before we just kick off here, Alessio, do you want to take us back a little bit to and talk a little bit about you, a little bit before what you did before you launched Creddy and how, and where Creddy is going?
Yes, certainly. Hi, Tim. It's a pleasure to be here today. Thank you for having me. So a little bit about me. So I started off my career in the Big Four, where I spent many years. At the Big Four, it's where risk management was really drilled into everything we did. They gave us a deep appreciation of governance, operational controls, and structured finance. Things that are not necessarily very exciting, but become extremely important, especially for what we do. And this is obviously before Credit. I then, after my experience at the Big Four, I then moved into private credit, and I help building a technology-driven lender operating across 3 countries in Asia, where we basically transformed what was essentially a pen and paper business into a fully fledged fintech business with a modern lending platform by applying my knowledge of machine learning, automation, and data analytics, as well as to underwriting and portfolio management. After that experience, I later founded my own technology-driven non-bank lender in the UK for B2B lending, where I designed proprietary lending platforms and developed my own machine learning credit risk model that became a part of my subject for my PhD. Across all of those businesses and my experience, I assessed thousands of lending applications, managed institutional funding lines, dealt with numerous types of frauds, defaults, recoveries, and so on. So that's kind of, if you want, that's probably all the biggest things that I brought into DeFi. The way I look at it is blockchain is a fantastic piece of infrastructure, but doesn't replace credit expertise. The hard part has always been the experience and knowledge of underwriting, legal enforceability, operational controls, and recoveries.
Yeah, no. So here at Turtle, of course, we have a platform where we connect LPs with different teams, and as part of the Turtle ecosystem, it's a lot of it comes down to due diligence, understanding the teams that we work with, understanding like their underwriting, and basically understanding everything around what they do. And one part that was really standing out, of course, was your background before Credit. And right now, if you go to the Turtle platform, you can see the Credit Vault on the Turtle platform. So we are happy to be a close partner. And with your background, like coming from like more of, let's say, the traditional world, and then coming into the crypto space and launching a platform that where can you talk a little bit about that journey and what you saw and basically what made you launch Credit and explain a little bit to the Turtle audience here as well what Credit do?
Yeah, absolutely. So just a little bit of a little further about my background. So my background has always been in data analytics, whether it was in I come from engineering background, but throughout my career I always work in data analytics. I wanted to apply that into and I've applied that into, if you want, private credit. But after my experience with a previous company, which I was the first appointed arranger for MakerDAO, where I've really learned and appreciated the benefit of blockchain, I decided to bring together both my knowledge of blockchain and my deep expertise of private credit. At its core, Credi is essentially an institutional private credit manager built for digital asset economy. So the traditional finance has spent decades refining how to originate, underwrite, manage private credit, but access to those opportunities have been largely limited to banks, private funds, and institutional investors. At the same time, the digital assets have created now a global pool of capital that's incredibly efficient, but has relatively few institutional quality opportunities. So I thought, well, Credi basically bridges the two worlds. We originate and manage real-world private credit opportunities, providing access and using the same underwriting discipline, legal structure, and risk management you'd expect from a traditional finance. But then we use blockchain to make those assets more transparent, accessible to everyone, more automated, and ready for global capital, really. We are not trying to reinvent private credit. We are modernizing it, if you want. We are modernizing the infrastructure around it. Traditional finance knows how to originate high-quality assets. Crypto knows how to move capital efficiently. And Credi sits at the intersection of these two worlds.
Yeah, because I've spent my whole, I got into the crypto space back in 2017. And I remember back then we were all talking about like banking people that did not have access to the banks, and back then it was like a lot of like idealism of where crypto and blockchain could take us. And then what we got over the last couple of cycles was a mix of like people that were trying to build businesses around different tokenomics and token models that were not sustainable. And we saw many different cycles of the same thing happening over and over again, where they tried to build a business around, let's say, marketplaces on the crypto side, where it was just crypto capital and it was all happening on the platforms, which made it very the boom and bust cycle. So it was like all like very good for a couple of months, and you could see like everything was perfect, and everybody thought it was going to go on forever. And then come the down cycle in the crypto world, and then it was very aggressive, which made it very hard for businesses to flourish and operate and grow. And when I first saw so I've been like from the crypto world, and I've always been like, and a lot of us are always like, where is like the revenue coming from, or where is like the capital coming from? And we are trying to understand. And in crypto, it's like, if you don't know, then you are where it's coming from. It's kind of like a meme. Like so when I started to see like the private credit, and it's like more traditional assets that anybody can have access to just by having it is democratizing opportunities in a brand new way, which made me very excited on the private credit, because it's maybe you can talk a little bit about that, actually, how big of a market it is, and how the private credit is one of the trends that we are seeing growing as well.
Yeah, I mean, look, private credit is well. First of all, private credit is it's a huge segment of the market, and can often mean many things to many people. I think for the assets we look at, to give you an idea, one of the two assets that we look at is invoice finance for small and medium enterprises, and that alone is worth 3.5 trillion globally, and that's one asset class with private credit.
So that's like all crypto times multiple times of the whole crypto industry times multiple. Yeah.
And you know, when I first decided to kind of look at bringing something on chain, obviously private credit was of course the first asset class that made sense, because to me it's highly structured, it's cash flow driven, it's asset backed, and those are all important principles. You are financing a real business with predictable repayment profiles, and you're not trying to tokenize speculative assets. Sorry, because you know, if and that's where one of the biggest decisions that drove me to bring this on chain, if you want. Blockchain, it doesn't change the underwriting, but it dramatically improves everything around the assets. So all the benefits we already know: transparency, settlement, reporting, and of course the ability to connect new global capital to these opportunities. I think right now there is no better time to bring this on chain. The entire ecosystem has matured. We now have also institutional custody, regulated stable coins. We are improving regulatory clarity in many jurisdictions. And I think investors are now starting to look really at a sustainable real world yield rather than something that is just speculative. I mean, those are good opportunities too, but I think these represent a fantastic way of diversifying your portfolio. I think private credit and blockchain are genuinely starting to complement each other. I think that's where we position ourselves.
So no, because at Turtle, we of course the slow and steady, the tortoise wins the race, and it's always like our, let's say, philosophy to be good like capital allocators and being like mindful with how you build, let's say, a portfolio, so that you can basically make sure that you are getting a risk adjusted yield that you want to, that is like, because you need to understand like all the different parts of it, and we know like when I speak with different LPs, I kind of understand like how they are thinking about it, and then okay, so where are the risks, how does that work, because this is a topic that like a lot of people doesn't want to talk about it too much, but for an investor and as an LP like myself, it's an important topic to touch upon, because it's a key part that sits at the center of it. And over the last couple of months, there has been some like, because in the traditional world, then in the traditional world, sometimes it can take like a couple of weeks to redeem different capital, and then a lot of different protocols are trying to structure their products in different ways, which is the key thing of how to well structure a vault that is a mix of like taking care of the LPs, protecting it, and how you can structure it in a good way. How did you think about like structuring the credit vaults recently when it comes into like from a risk perspective? I know, for example, like from that perspective, how did you think about structuring the credit vaults?
So the first thing we always do is obviously look at credit discipline, and specifically traditional credit discipline, because what we have learned over the last few years is, you know, so especially in DeFi, many protocols have focused on tokenizing yield before actually building institutional credit infrastructure. And whereas we actually started looking at that first, and then leveraging blockchain. So we look at things. The first thing that normally breaks in many cases is underwriting, where people become comfortable because the assets are on chain, but tokenization doesn't improve the quality of the underlying borrower. So what we look at is the way we manage risk is really looking at the structure first of the borrower, and assessing the borrower. We look at the entire ecosystem of, if you want, counterparties that are part of that ecosystem. And the third and most often the kind of overlooked part is to looking at the controls of cash flow, legal rights, incentives, and so on. So when you ask how do we structure that and kind of align that, it's part of aligning all of these fundamental principles to the incentives that LPs are looking for. One of the things that has often gone wrong in the past is exactly that: is you're trying to do private credit on one side, and on the other side you are offering daily liquidity to your investors, and that's not something that is generally aligned.
Yeah, because we could see like this in over the last couple of weeks, especially, we saw some where it was a little bit. There was some DeFi protocols where it was like let's say a mismatch in the liquidity window. So sometimes it could take like, let's say, a couple of days to redeem certain allocations in certain products. But then on chain, everything is happening 24/7, and it's a very like you need to be well adjusted in order to balance the expectations, because on the crypto side we have gotten used to like the instant, like you can the instant part, but in the traditional world it works a little bit differently, which kind of like, if I would ask you the question like this, what was the main value from your side, also why to bring it on chain and to access, what was the main value from your perspective to also bring it on chain?
Yeah, I think yeah, I mean, it's the reason we wanted to bring it on chain is again it's providing access to to LPs for these opportunities. But the other reason was also to try and eliminate all the inefficiencies that exist in traditional finance. And this is one of the reasons we decided to bring it on chain, if you want. And I think this is the time. I mean, as I said earlier,
100%.
The time is it is maturing now. It is becoming more institutionalized, and so why not bring it on chain? But it's important to know that bringing something on chain doesn't necessarily improve credit risk. Bringing something on chain simply provides more transparency in terms of both information and the management of the portfolio, as well as access to great opportunities. But it doesn't eliminate the need of great underwriting and institutional underwriting, so to speak.
Yeah, no, I fully agree there, Ned. And I think if to take a little bit a step back and just think of like the broader market, and what we have seen is that even though we have seen on the crypto token side, on the governance tokens of different, it has been like over the last year, it has been a little bit a year of struggle. Some people say it's like the 4-year cycle for BTC and Ethereum, like the traditional 4-year cycle. But when we check on tokenization and stablecoin, then it has been a very good year. And you can see like over and over, you see more appetite from, and this is something we see as well, like from liquid funds, from family offices, angel investors like myself, and like a lot of founders out there that are very interested in accessing opportunities that are maybe not correlated directly to the crypto markets as well, because that's part of being like a good capital allocator, where you are strategic with, okay, maybe you want to have some assets, but you still want to stay on chain and within the let's say that ecosystem, but you want some assets that are not related to, let's say, what's happening directly with Ethereum or Bitcoin. And that's also
absolutely.
one. Yeah, go ahead.
No, I think it's a great point. I mean, and partly this is one of the main way we've designed our products as well, with that in mind specifically, because you will always have bear markets and bull markets. You will have fluctuations in prices, bitcoins, ethereums, and so on. But private credit offers you which is the way we design our products. It's a fixed income return. At the end of the day, it's a credit product that is financing a real business with real cash flow and predictable repayment patterns. And therefore, it allows you to provide that kind of fixed income product that can insulate you from market fluctuations.
Yeah, 100%. And we can also see, like, let's say, for example, different crypto and fintech teams where, let's say, they have raised, let's say, X amount of, let's say, 10 million, 20 million, and they are thinking, like, how can we manage our treasury? And how can we balance a portfolio around that? And and then one part is like, okay, a product like credit is kind of like it could be a good thing to look into, because for a portfolio like that, then I think what we are seeing is that more and more people are also allocating it to real world assets and things that is not directly correlated to the crypto market, because it brings a little bit more stability into your portfolio and into your treasury management.
Yeah, that's absolutely right. So one of the things we are looking at is exactly that, because we have focused on short duration assets, where the weighted average life of our assets in one of our portfolio is 3 to 5 working days. It allows us to support exactly those needs, so position ourselves as a good alternative cash management solution for treasury functions, because we can offer different level of liquidities with robust returns that are backed by real world assets. So they're not backed by speculative investments or assets that are exposed to market fluctuations.
Yeah.
So you're absolutely right. The other important things to look at is, obviously, tokenization is fantastic, and we've talked about some of the benefits already. But what's important is, and this is what we focus on, it's to provide both treasury functions or institutional or individual LPs that certainty that capital protection is there. What we think first and foremost is the structure of any deal, the structure of that we put around both from a legal point of view in terms of recovery, but also in terms of legal ownership assignments, and most importantly, control of cash flow. These are 3 pillars of our the credit underwriting we put in place to ensure, yes, that we can still offer robust returns, and we can do so on chain. But these are fundamentally backed by really solid traditional legal frameworks and operational frameworks.
Yeah, I think one of the most beautiful things with on-chain is also that previously, if you take from over the last, let's say, 10, 20 years, a lot of these private credit opportunities has been reserved for, let's say, private funds, banks, and been sitting kind of like behind. It has been very hard for, let's say, you're in retail or you're an average investor to find those opportunities, because it has been banks or private funds that have been taking care of it. But with on-chain, then also the retail user, which is a core part of here at Turtle, a lot of our investor could be, and a lot of the Turtle community can be people that have been in crypto for a very long time, and they are kind of like managing like a small family office. So a key part has been that you can now, with the help of on-chain, also provide access to retail and to the broader community with these opportunities, which is kind of like something that really stands out to me, and is also why I was very excited to invite you here, Alessio, to the Turtle live stream.
Yeah, no, I completely agree. I mean, as a retail investor, you definitely never have access to private credit opportunities unless you're an extremely large investor, and they've generally been solely allocated to banks, family offices, and large asset managers. But the other thing that on-chain has done is bringing this on-chain is not just facilitating that access, but it's also bringing the efficiency we know blockchain brings in terms of capital movement, particularly. And what that does is in private credit, traditionally, there's the ecosystem has so many intermediaries that even if you had access to private credit opportunities, each one of these intermediaries would then basically have operating costs associated to their inputs or involvement. And so we are not only able to provide access to this opportunity, but also deliver bigger value to LPs that you normally get in traditional finance.
Yeah. And also, like, over the last couple of weeks now, we have seen big announcements coming out of Tempo. So they want the chain from Stripe, from Arc. They launched like the new open dollar stable coin that is backed by, I think it was 120, like Visa, MasterCard, all of the biggest companies out there. And we see more and more on-chain and what they're talking about. And then yesterday we had Robinhood as well launching their Hood chain, like an Ethereum Arbitrum layer 2 that was like the real-world assets-focused chain. So you see like so much attention coming into the space, and there's so many different things out there.
Yeah, I think, yeah, sorry to interrupt, go on.
No, and I was just going to dive into a little bit, like, it's all over, and we are seeing that the wave is here for credit and so on going forward. But of course, there's a key part, which is that when it's on chain, then you also need to underwrite it, and you need to trust the counterparty that you are working with. So I just wanted to, if you could educate, of course, the Turtle community, how do you view like your process of, let's say, underwriting assets, and and how should you do it the right way?
Yeah, it's very simple. So how should we do it? We should do it exactly the same way as if we were underwriting off-chain. The underwriting, the traditional private credit underwriting has been developed over decades, and it shouldn't change just because it's on chain. So the first thing we say, and I touched upon earlier on, the first thing we do is we underwrite a borrower. Do they have enough financial strength, operational capabilities, incentives to repay the loan, then more importantly. And then we look at the assets. What is the assets? Are they cash flow predictable? Is it the duration we seek in an asset? So as I mentioned earlier, at the moment we look at two asset classes. One is 3 to 5 working days. The other one is 30 days. So both short duration assets. Can they be easily diversified? Can you value it independently? In our case, it's relatively easy, but and so on and so forth. And third, and most importantly, which is often overlooked, in terms of, as part of the underwriting structure, is who controls the cash flow? What are the legal rights if something goes wrong? Are the incentives aligned? Of course. And what happens if the borrower defaults? Only after we answer all of these questions, you should think about blockchain, because at that point, blockchain becomes the infrastructure layer that gives you better transparency, automation, and efficiency, but doesn't replace all the credit underwriting. I think the biggest mistake people make when talking about on-chain private credit is that you're not underwriting a token, you're underwriting a legal claim on future cash flow. And you're underwriting very traditional assets. Does that make sense?
Yeah, no, that makes fully sense, because, like, let's say from my side, like let's say me as an investor, how I would go at it, like it's a little bit like I will have to rely on a party or an audit to kind of like understand all the different parts of it. And then when it comes to who to trust and who to work with, then you kind of need to, like as an investor, like as a responsible investor, you kind of at least want to understand, like on a high level, how it works and who was it that did the underwriting. And that's where it's important for companies and teams like you at Credit to communicate to, and I think this is something you have done when you check on like across socials and across like sessions to educate your investors of what process that went into to the credit vaults, so that they can kind of like trust and understand and dive into it.
But I think this is a very important point, because I actually think that in both traditional finance or on-chain finance, an LP shouldn't be expected to underwrite every individual credit opportunity. That's the role of the credit manager. I think LPs should ask a different question. Can I trust the underwriting process? And I think that's the key. That means looking at the credit manager experience, the underwriting framework, the legal structure, the incentives alignment, how the portfolio is monitored, which is perhaps the most important part. Because when things go wrong, those are the things that really matter. What I think it's important now is that what blockchain changes is now that the investor doesn't have to trust the underwriting process blindly. They actually have a much greater visibility into the portfolio activity, in the cash flow, in the performance that the portfolio has historically had, and they can verify, more importantly, that the capital is being deployed. They don't have to wait for monthly or quarterly reports that still can hide things. That everything is so transparent. I think that's the most important aspect.
Yeah. If could you just so for myself, I'm also an LP, and I was happy to because I've done my due diligence on you from just as a personal individual, and I was very excited. But like, can you explain a little bit to the investor and LP community here around how is kind of like a deal structure? If you can talk a little bit about like high level of how the connection between the different parties comes together in like one of the credits deals.
Yes, let me give you the example of our on-chain receivable finance portfolio, for example. Now, if you look at this asset class, this is if you look at the actual credit product, the asset itself, this is a very old-fashioned product. We're basically doing merchant cash advance on credit card transactions at its fundamental level. But how do we structure this? Well, first of all, there is a borrower. We need to do an assessment on that borrower in terms of what we mentioned earlier, in terms of looking at their credit worthiness, looking at their business plan, looking at the historic performance in terms of not just balance sheet, but also P&L and cash flow, more importantly. And then we look at the entire value chain of that deal. So we look at what other parties are involved into that deal, and what are the operational risks associated to each one of those parties and the value chain as a whole. So in this case, for example, we first of all, once we have assessed and decided to move ahead with a loan in this specific area, first of all, we want to see the borrower credit worthiness to meet specific criteria. We look at historic performance in terms of chargebacks and refunds on the credit card transaction processed by the borrower. And more importantly, we look at the counterparties that they deal with. So who are the counterparties in this value chain that support this deal? So in this case, we work with appointed partners of the Visa Ramp program. So needless to say, they need to be appointed partner of the Visa Ramp product. That's the first thing. Secondly, in order for this to work, they need to interact with a merchant acquiring bank and with a Ramp provider. So the second thing we look at is the strength of these two counterparties, the regulatory compliance of these counterparties. So, as you know, in Europe recently there's been a change over a regulatory change around MiCA or MiCA. Is the RAM provider MiCA compliant? Are they still going through the process? Are they fully regulated? Where are they regulated? What is the jurisdiction, and so on? Once we have all these pieces of the puzzle together, we look at the legal framework and how we bring this together. So to give you an idea, in this particular case, the first thing we do when we decided to go ahead, we put a first ranking debenture on the actual borrower, so on its business and all of its assets, and we make sure that this debenture is, or security, is fully executed and approved by the board. Secondly, we ensure that every legal jurisdiction has been covered by taking legal opinions from the local legal representatives. We then make sure that the legal assignments of the assets is enforceable within the jurisdictions that we have selected. And finally, we get the relevant parties to sign an acknowledgement that those assets are being financed by us, they are owned by us, and they should be paid to us. That gives us control of the cash flow as well as all the assets of the company in case anything goes wrong. So what you're doing there, it's basically when you're underwriting, you're not looking at a framework for when things go wrong. You look at a framework that you can enforce without thinking, that you can enforce as soon as things go wrong. Those are the things we look at. The third and final thing is, of course, it's all around diversification. Is the portfolio sufficiently diversified? Can it ramp up? Can it grow with us, and so on? But those are the main areas that we assess.
Yeah,
and of course the strength of the team itself.
of course, it's in the finance world. One of the key things, of course, is around like reputation and being there for a long time and establishing trust through basically doing the audits and taking care of it and dotting all of the lines and making sure that you are aligned to it. And around MiCA recently, of course, it has been like some. I think from our side, we have always been working to like get ready for it, because when we operate within EU, then it's the rules of the land, and you need to
Right.
be very mindful about where you operate. And I think that's a key thing. How do you view? We will dive into a little bit now of where we think that the landscape is going. So I wanted to, how would you say, of course, like we're not here to forecast, but like if you see some trends that you see happening within, like say, the tokenization, private credit over the next 12, 18 months ahead, what are some trends that you're seeing in the space right now?
Yeah, I mean, yeah, I definitely see that things are becoming more institutionalized, and I think, you know, with the introduction of more kind of regulated parties, like we were talking earlier about, regulated vault providers, regulated stable coins. I think what it's happening is that is attracting, as well as attracting the natural audience that we already had on chain in terms of LPs, is finally attracting more institutional investors as well. You made the example of two companies, organizations that are now entering the payment space. I think Visa is the perfect example there, right? So the adoption of on-chain by players like Visa, that's for me it's a no-brainer, but it's a great It's a great example of institutionalization and maturity. Um, Visa, for example, has to in the past to function had to manage many different functional currency at the same times, and the treasury was incredibly the treasury management was incredibly complex. So moving into adopting a program like RAMP, for example, that enables the settlement of credit card transactions in USDCs, that it immediately simplifies the business model. I think what the way I look at it in a few years, what I would like to see is that we no longer talk about on-chain private credit, but simply private credit, because the
Yeah.
on-chain part has been wildly adopted as the
Yeah.
infrastructure of the future.
Yeah, no, 100%. And some other exciting things we have been seeing is like a lot of the events has also been much more focus on like the traditional world. For example, we were in Paris, like during Paris Blockchain Week, and we could feel the vibes of how the traditional world and the crypto world are slowly like merging and coming together under the tokenization and real world assets. And I had a lot of very interesting conversations in Paris during Paris Blockchain Week. And towards the end of the year, I can see how, for example, at Token 2049, Korea Blockchain Week, and more of the crypto events as well are also focused around tokenization, real world assets, and on-chain credit. And we are going to be at a lot of them towards the end of the year, and quite a lot of big things happening in Asia as well. And from some level, like if you just look at, let's say, the crypto markets, and what you hear on CNBC is like that BTC price, and you see a lot of that. But when you look on the tokenization, and then it's just flourishing, and the space is growing, and you can see like how quickly it is growing, and then the biggest banks are forecasting, and they're trying to like predict of what's going to happen over the next couple of years. And then you can see how I think it was Standard Chartered, they did some they were diving into like Morpho, Aave, and these players, and then they were like trying to forecast like how much of the on-chain economy that is going to be real world assets, like private credit and everything. And from our standpoint and from your standpoint, it's a very strong trend, and you can see how the wave is quickly growing here, and credit is very, very well positioned on this within this trend. And based on your track record and your history, of course, like you're perfectly aligned here within the trend. If you could talk a little bit about credit and what you have planned, like how can our community also engage more with credit? What are some things that are happening right now from your side until, let's say, the end of the years? Until the end of the year. Is there any? Yeah.
Actually, the first thing, if you allow me, that I would like to clarify, because I've come across this in the past quite a few times. I'd just like to clear up one of the biggest misconceptions about credit. We are not a DeFi lending protocol. That's not who we are. At the core, we are just simply a private credit manager, and our expertise is originated excellent quality assets, underwriting borrowers, structuring the transaction, and most importantly, directly managing those portfolios. So we are not a DeFi lending protocols, nor a marketplace. We just said we're just talking about the future. So in the past decades, I think crypto has built this extraordinarily capital infrastructure, and traditional finance has spent decades perfecting credit. The next generation, I think, will be financial markets will come from combining those two strengths, which, as you said, we truly believe we are exactly at the perfect intersection of, and they will not replace one another. So going forward, how they can we interact? So obviously, we've launched our partnership with Turtle. We're soon going live with a transparency dashboard that we will enhance further the transparency that we bring on our on-chain portfolios. And the transparency dashboard will present basically a tested asset valuation by independently attested by Accountable and Chainlink. That's the first part. We are also looking at launching looping strategies and launching other exciting partnerships that enhance the value we can bring to LPs without compromising the quality of the underlying assets that we have brought to the on-chain. So that's but people can interact with that simply either through Turtle or directly with us on our credilabs.io.
Yeah, no, it's like on the Turtle platform, it's one of the featured campaigns on the Turtle platform. So if you go to the app.turtle.xyz, you can see the Credi USDC vault at the top there, and anybody can interact with it. So that's an easy way to interact with directly with Credi. Yeah. And you mentioned you had some other types of products coming up, some education around like on the transparency side. Yeah. We also actually had a few questions from the Turtle community because go ahead.
Timmy, I just want to mention also, at the moment we have a pipeline of a high quality private credit assets on chain and off chain. Worth about $100 million. So one of the benefits of having owned my own non-bank lender in the past is often lending, it's a challenge between liquidity and origination. And what we've done from the very beginning is solving for origination first and ensuring that we have a sustainable growing pipeline of origination of high quality assets so that we can solely focus on growing our liquidity once that was solved. So that's where we are at the moment, and we're basically looking to fund that fantastic pipeline.
Yeah, actually, so I was before here. We always do before these lives. We talk with some investors and LPs, and we kind of like try to understand like because on-chain private credit, then Credi is one of the it's a little, of course, it's a bit of a growing market, and so we try to understand like what questions might some of our LPs have, and one of them was around like how would you in your mind like compare, let's say you're running a portfolio, and then you're trying to compare it to, let's say, DeFi. How would you compare the two in your mind? And should you in a portfolio have a little bit of both, or how would you compare it with like traditional DeFi?
I mean, look, at the end of the day, the choices of an investor will be personal choices, but obviously, like any portfolio, you'd want a portfolio to be diversified. All I can say is the difference between DeFi and private credit on chain is private credit is not speculative. It's a real asset at the end of it. And it's a real asset that is fully predictable and based on cash flow and predictable repayment patterns that is supported by a real legal structure. So you're not tokenizing credit risk. That remains firmly on a traditional basis and foundation. So I think if it's not the main part of your portfolio, it should definitely be a part of your portfolio. And certainly because it's, as we mentioned earlier, it's a fixed income product, which with a robust return. So it provides you with your portfolio with a good coverage when times are good or times are bad. It's always fixed and it's always there. Yeah. It's not affected by market fluctuations.
Yeah, no, it's definitely one of the because especially if you are let's say you're a DeFi protocol and you are managing a treasury, or you're a liquid fund and you have a certain amount of capital that you want to have a specific yield to manage operations with, for example, and then you can it's predictable because and of course that's one of the key selling points and one of the key reasons why more and more people are moving and allocating more capital towards private credit. And when you check, like I was reading some study around it, like both as a market but also as investors, how it was a very, very strong growing industry, and it's like you have a strong pipeline from your side that you can bring to market. It's of course showing that there is a lot of room to move in there, and especially when it's a very competitive yield compared to some DeFi opportunities, and with a not correlated risk correlation to the crypto markets per se, is a very attractive product.
Yeah, and actually, one thing I'd like to clear that is you just brought up around the it's a robust yield, and often when people look at the yield thing, higher yields meaning higher risk. That's certainly true, but not always. Sometimes the higher yield is because you are addressing a part of the market that is underserved, and historically, the specific slice of a private assets we're looking at, private credit, it is underserved. SMEs, since the great financial crisis, are no longer served by banks. But that doesn't mean they're bad assets or toxic assets. They're actually, in some cases, equivalent or comparable to AAA vehicles. The only other point I want to make is it's a great way of diversifying your portfolio, but also it may not be important for everyone, but it is certainly a passion of mine. By investing in private credit, you're actually putting money in the real economy, and that's a really fantastic message to send.
Yeah. No, because of course, like when you provide, let's say, liquidity to as a lender, then you are, of course, yeah, like you said, bringing capital into the real economy and putting it to work, which means that they have also quite high, I would imagine, like capital efficiency.
Correct. And if we've done recently an interview with one of our customers, I think you can find it on our LinkedIn profile. But yes, it's exactly that. Where they see actually using credit rather than equity raise is a lot more efficient and economic.
Yeah,
cheaper than giving away equity.
Yeah, no, it's an interesting. It's an interesting part of the market because it's something that you hear about, and I think like if you listen into this full session today, a lot of people have probably gotten a deeper understanding how private credit works, how to underwrite it, and how you can basically step by step understand like how it goes from how it goes through step by step to becoming a product that you can vault on chain.
Yeah, exactly.
So awesome. Yeah, I think we have had a good session here today, diving into everything related to Alessio's background, how he came about like starting off Credi, and we are going to hear a lot more about Credi over the next couple of months as well. If you would like give like a short little pitch to, let's say we would do a little elevator pitch to an LP here that just joined in at the end of the session here and just want to hear a little bit like how, if you could give a little elevator pitch here for Credi to finish off the session.
You're testing me now after after an hour of this. Well, look, we as I mentioned earlier, we are not a Credi. It's effectively a credit asset manager that brings on chain high quality private credit assets and makes use of blockchain to provide LPs with access to these opportunities, robust returns, efficiency, and transparency. We are at the perfect intersections between traditional finance and decentralized finance.
Perfect. No, it has been a good session here, and of course, like from my side, when I would pitch it here, of course, it's not. So my opinion would be like that how I would view private credit and to an LP, and of course, it's not financial advice do your due diligence, dive into it, and understand it. But how I would pitch it would be around, let's say like this: you are a capital allocator and you're building up a portfolio of different you're allocating capital between different pools of in a portfolio, and then you're building it out. Of course, there's a lot of opportunities within DeFi, new ecosystems coming up on both stable coins and on traditional assets. And then you can now see like Turtle have added some gold opportunities. And to build a responsible portfolio, in my opinion, would be that you are careful about allocating into different buckets. And in my bucket, I would add private credit as one that is not correlated to the rest of the market. And if you're if you're managing a treasury liquid fund, then I think private credit is something definitely to explore. How can people learn more about Creddy and about it? Should they go to your website? Is there any?
We are constantly publishing great content on our X channel at Creddy Labs, our website creddylabs.io, or our LinkedIn pages. But we will try and do more and more of these AMA and live stream session, taking on more questions from LPs or attendees, so that we can bring more about our offering and how we do things.
Awesome. And maybe a final thing, if you go on the Turtle website, then you can also read more about like the audits, the due diligence, and you can learn a lot more on the Turtle website, on the portal. So thanks so much, everybody, for tuning in. It was a pleasure to have a good conversation with you, Alessio. I'm looking forward to the next one. And thanks so much, everybody, for tuning in today.
Thanks so much. Thank you.
Thanks so much, everybody. Have a good rest of the day.